Imagine waking up tomorrow and everything costs 20% more. Your coffee, your rent, your groceries, everything. You'd probably panic, right? You'd demand answers. You'd vote people out of office. You'd storm the streets. But that's not how inflation works. Inflation is smarter than that. It creeps up on you like a thief in the night, taking a little bit here, a little bit there, until one day you wake up and realize you can't afford the life you used to live, and by then, it's too late. This is the story of how inflation quietly destroys your life, and why most people never see it coming until the damage is already done. Let's start with a simple question. When was the last time you paid the exact same price for something you bought a year ago? Can't remember? That's because it probably hasn't happened. Everything gets more expensive over time, and we've been conditioned to accept this as normal. But here's what's really happening behind the scenes. Your money is losing value every single day, and most people have no idea how devastating this process really is. The Federal Reserve targets 2% inflation annually. That sounds harmless, doesn't it? Just 2%. But let me put this in perspective. At 2% annual inflation, your purchasing power gets cut in half every 35 years. That means if you're 25 years old today, by the time you're 60, your money will only buy half of what it buys right now. And that's if inflation stays at the target rate. In reality, it's been much higher in recent years, accelerating this wealth destruction process. But the real insidious part isn't the math. It's how inflation works psychologically. It operates through what economists call the boiling frog effect. If you throw a frog into boiling water, it jumps out immediately. But if you put a frog in cool water and slowly heat it up, the frog doesn't notice the temperature change until it's too late. That's exactly how inflation works on your financial life. Let's talk about death by 1,000 cuts. This is how inflation actually operates in your day-to-day existence. It doesn't announce itself with dramatic price jumps that shock you into action. Instead, it nibbles away at your purchasing power through seemingly insignificant increases that individually feel manageable. Your morning coffee goes from $3 to $3.25. Your grocery bill creeps up from $150 to $170 per week. Your car insurance renewal notice shows a 15% increase. Your rent goes up $40 a month. Your phone bill adds a few new fees. Your streaming subscriptions each raise their prices by $1 or $2. None of these increases feel catastrophic on their own. You can absorb a 25-cent increase in your coffee price. You can handle an extra $20 per week in groceries. Each individual price increase feels like a minor inconvenience rather than a financial crisis. But here's the trap. These small increases are happening simultaneously across every category of your spending. Your housing costs are rising, your transportation costs are climbing, your food expenses are increasing, your healthcare premiums are going up, your entertainment costs are growing, your utility bills are expanding. When you add up all these seemingly minor increases, they create a massive erosion of your standard of living. Let's do some quick math. Say your monthly expenses are $4,000. If everything increases by just 5%, your new monthly expenses are $4,200. That's an extra $200 per month, or $2,400 per year. But your salary probably didn't increase by 5% to match, did it? Even if it did, you're just breaking even while your actual purchasing power stagnates. The psychological component makes this even more destructive. When prices rise gradually, people don't react with the urgency they should. Instead, they make small adjustments to their behavior that collectively represent a significant decline in their quality of life. They buy cheaper groceries, delay purchases, reduce portions, choose generic brands, postpone maintenance, cancel subscriptions, and make countless other micro-compromises. This is where the psychological trap becomes truly insidious. Rather than recognizing inflation as the thief that it is, people internalize these changes as personal failings or inevitable realities. They tell themselves they need to be more frugal, more responsible, more realistic about their expectations. They lower their standards instead of identifying the real culprit behind their financial squeeze. Think about your parents' generation or your grandparents' generation. They could afford houses, cars, vacations, and comfortable retirements on single incomes. Today, dual-income households struggle to achieve the same standard of living. Did people suddenly become less capable or less hardworking? Of course not. The difference is decades of cumulative inflation quietly eroding purchasing power faster than wages could keep up. The most devastating part is how this affects long-term wealth building. When inflation outpaces your ability to save and invest, you're essentially running on a treadmill that's speeding up while you're trying to move forward. You might feel like you're making progress, but relative to the cost of everything around you, you're actually falling behind. This creates what economists call the inflation tax, and it's the most regressive tax of all. Unlike income taxes that theoretically scale with your ability to pay, inflation hits everyone equally, but impacts lower and middle-income people disproportionately. Wealthy individuals can protect themselves through asset ownership and investment strategies, but regular people see their savings accounts lose value while their paychecks buy less and less. Now let's talk about the defensive moves you need to make. The first thing you need to understand is that you cannot beat inflation through emotional responses or wishful thinking. You can't budget your way out of systematic currency debasement. You can't coupon clip your way to financial security when the underlying monetary system is designed to transfer wealth from savers to borrowers. You beat inflation structurally by understanding what it really is and positioning yourself accordingly. Inflation is essentially an increase in the money supply that dilutes the value of existing currency. When governments print money or create credit, they're not creating wealth. They're redistributing existing wealth from everyone who holds that currency to whoever receives the newly created money first. The defensive strategy is simple in concept but requires discipline to execute. You need to convert your depreciating currency into assets that maintain or increase their value over time. This means getting out of cash and cash equivalent investments that lose purchasing power and getting into real assets that benefit from, or at least keep pace with, inflation. Real estate historically performs well during inflationary periods because property values and rents typically rise with general price levels. Stocks of companies with strong pricing power can pass increased costs to consumers, protecting shareholders from inflation's effects. Commodities like precious metals, energy, and agricultural products often appreciate during inflationary periods because they represent real, tangible value rather than paper promises. But here's what most people miss. The timing of your defensive moves matters enormously. Once inflation becomes obvious to everyone, asset prices often overshoot as money rushes to perceived safe havens. The key is positioning yourself before the crowd recognizes what's happening, not after. You also need to think about your human capital. In inflationary environments, skills that can't be easily automated or outsourced become more valuable. Focus on developing capabilities that allow you to raise your prices along with, or faster than, general price increases. This might mean learning high-demand technical skills, building your own business, or positioning yourself in industries that benefit from inflation rather than suffer from it. Debt strategy becomes crucial too. Fixed-rate debt is your friend during inflation because you're borrowing today's expensive dollars and paying back with tomorrow's cheaper dollars. Variable rate debt is dangerous because your payments increase along with interest rates, which typically rise during inflationary periods. The most important mindset shift is recognizing that inflation isn't a natural economic phenomenon like the weather. It's a policy choice with winners and losers. The winners are typically governments that can inflate away their debt burdens, banks that profit from the increased lending activity, and asset owners who see their holdings appreciate. The losers are savers, fixed-income retirees, and anyone whose income doesn't keep pace with rising prices. Understanding this dynamic helps you position yourself on the winning side rather than hoping things will somehow get better on their own. It won't happen through political promises or central bank communications. It happens through your personal financial decisions and your ability to adapt to the reality of how the monetary system actually works, rather than how you wish it worked. The quiet destruction of your purchasing power isn't an accident. It's a feature of the current monetary system, not a bug. Once you understand this, you can stop being a victim of inflation and start being someone who prospers despite it. The choice is yours, but time is not on your side. Every day you delay taking defensive action is another day inflation chips away at your financial future. Please like, subscribe, and share to follow us and see more content like this. Check our other videos. New content weekly.